Hey everybody, welcome back to the Wealth Journey. In this video I want to talk to you about dividend yield against dividend growth and which is the best to invest in. So let's just dive straight in and bring up what I've been working on for you. Now, if you don't want to watch to the end, then literally look at the statement in the bottom right of the image and that gives you the answer. But if you want to understand the maths and get a deeper understanding, then stick around and see what I have to say. This is not investment advice, and the companies I have chosen are for illustrative purposes only. So what we have here is a lot of numbers and colours which look good at first sight but give you no real understanding as to what's going on without an explanation. What I've done to help me illustrate my point is compared three different types of companies. So in the top left, where it says Visa, Lowe's, Johnson & Johnson, they're the three companies you're going to be using. Visa, for those who don't know, do basically financial payments, so your debit and credit cards like MasterCard. Next up, Lowe's, who, like Home Depot, are the US version of, let's call it B&Q here in the UK. And finally, we have Johnson & Johnson, who make and sell medical devices, pharmaceuticals, and consumer packaged goods. So in this example, we're going to class Visa as a growth company that pays a small but rapidly increasing dividend. So currently they pay around 0.6% dividend yield if you were to buy now. So what that means is for every £100,000 you have invested, you would get £600 back in the first year. But they are and have been increasing the dividend payment by around 18 to 20% each year. Next up in the example is Lowe's. They're still a growing company, maybe not to the extent that Visa are, but have a higher and probably a middle of the road dividend yield, but they're also growing the dividend payment at double-digit rate each year, anywhere from 10 to 15% and slightly higher in the recent past. And the final company is Johnson & Johnson. They are a very steady, stable company that grows probably in line with the general market. They pay an above-average dividend yield of 2.5%, something in that region, and have grown it consecutively over the past 60 years, making them a dividend king. They're currently growing at around 6 to 6.5% each year, so above inflation. So if you cast your eyes over to the, let's call it the Waterfall Chart down below, where it's got the red, amber and green, this basically compares what the dividend yield will be based on the different dividend growth rates above it year after year after year. So if that number is in red, then comparably that is third out of the three companies in question. If it's amber, it's in the middle, and if it's green, it means it's the highest yield by that point. So what I'm trying to illustrate is which you should focus on for different time periods or returns. In this example and whole image, we are not bothered about the capital growth, and we will not be reinvesting dividends each year or adding more to the pot. This is purely a snapshot in time to show the value of dividend yield against dividend growth. So you've added your £100,000 to the pot this year, and just leave it with Visa to increase their dividend payment by, in this example, 18% for the first 10 years. And you may think that's high, but for reference, they've increased it by 24.6% compound annual growth rate for the last 10 years in question. What I've then done is said, well, for the next 10 years, between years 11 and 20, drop it down to 14%. And what that means is that after 20 years of giving Visa your money and working their magic, they would be providing you with a nearly 10% yield on your capital that you put in, so paying you nearly £10,000 per year as a dividend. Because the dividends are getting raised each year, you're gaining more dividends each year without having to buy any more shares or sell your initial investment to have it as cash flow. If you're somebody that needs the cash flow now or within the next 10 years, then, well, one, you need to have a larger pot to deal with, but you want to be looking and focusing on higher dividend yield companies. So in this example, Johnson & Johnson, other companies like Coca-Cola, PepsiCo, Procter & Gamble. But for those in my position who have time on their hands to let the good quality companies work their magic and grow the dividend, then really you or I should be looking towards more dividend growth companies, so the Lowe's and the Visas of the world. But it all depends on when you're wanting to take your income. Please just remember that these numbers do not account for inflation, and they do not include dividend reinvesting, which is a powerful tool which I will come on to in a future video. This is purely just investing that one-off sum and letting the good quality businesses work your money and increase the dividends each year for you. So if we move over to the top right, which has the grid containing total dividends paid and yearly average equivalents, this puts into perspective the amounts of dividends you could look to receive in each of the 10-year time period buckets. I think it's interesting to see the trade-offs between short-term income and yield against the long-term benefit from the faster-growing dividend growth companies, and where the lines on the graph in the middle intersect show in the future the dividend growth companies becoming more of a higher-paying portfolio for you. Now, in summary, the answer to the question which I posed, which is best? Well, there isn't one answer, and it depends. Now, I know this will probably frustrate some of you as you're expecting a black and white answer from me, but it depends on your time horizon as to which is best for you to invest in. If you are young or have a longer time horizon or longer view on it, then higher dividend growth will reap rewards later on better for you. Whereas if you're seeking short-term instant income here and now, well, then you need the yield. I personally, and this is not investment advice, this is just my situation, believe that a combination of the two is better suited. So the Lowe's in this example, or Home Depot of the world, are better suited to the situation. Now, I hope you've enjoyed the video and found it interesting with all the different numbers and colours, paint by numbers. If you want a free share, then sign up to Freetrade, the app I use for investing, using the link in the description below, and you'll get a free stock worth anywhere between £3 and £200. Please check out my other content if you've enjoyed this, but until next time, stay safe.